Altria Group is one of the most unique companies in the consumer staples sector. Unlike most global tobacco companies, Altria operates almost entirely in the United States. Its core business is traditional tobacco, led by Marlboro, the #1 cigarette brand in the U.S. While cigarette volumes continue to decline, Altria has mastered pricing power. Higher prices more than offset lower volumes, allowing the company to generate extremely stable and predictable cash flows. Altria also earns money from smokeless tobacco brands like Copenhagen and Skoal, oral nicotine products such as On, and a strategic equity stake in Anheuser-Busch InBev. What truly sets Altria apart from other tobacco companies is its focus on the U.S. market, its superior margins, and its commitment to returning cash to shareholders through dividends. Altria is not a growth story, it's a cash flow and income machine. Here are the key risks facing Altria as we look ahead into 2026 and beyond. Regulation and public health pressure. The tobacco industry is one of the most heavily regulated sectors in the world. Governments continue to tighten restrictions, raise age limits, restrict advertising, and pursue nicotine reduction policies. These regulatory pressures can affect demand, product availability, and long-term industry structure. Declining smoking volume. Traditional cigarette consumption continues to decline in the United States. While Altria's pricing power partially offsets volume losses, ongoing declines still present a fundamental headwind for core revenues over time. Legal and litigation exposure. Altria and its peers have long faced legal challenges related to health impacts of smoking and product liability. While many major cases are behind the industry, new suits or shifting legal standards could create financial or reputational risk. Product transition risk. Altria is investing in reduced-risk products like oral nicotine pouches and heated tobacco alternatives. However, execution risk remains high. If consumers don't adopt these products as expected, revenue replacements may lag. Taxation and excise increases. Tobacco products are subject to federal, state, and local excise taxes. Further tax increases can dampen consumer demand and squeeze margins, especially if they outpace pricing power. Reputation and ESG pressure. Public perception of tobacco companies remains a challenge. ESG-focused investors may avoid tobacco stocks outright, which can limit valuation multiples and institutional demand. Before looking at the future, it's important to address the mistakes and challenges Altria has faced over the last 5 years. JUL investment failure. One of the biggest strategic mistakes was Altria's investment in JUL. The company invested billions at peak valuations, only to see the value collapse due to regulatory crackdowns, lawsuits, and declining consumer trust. This resulted in massive write-downs and destroyed shareholder value. IQOS commercialization setbacks. Altria initially partnered to bring heated tobacco products like IQOS to the U.S. market. However, regulatory hurdles, patent disputes, and limited rollout delayed adoption and reduced the expected impact of this reduced-risk product strategy. Capital misallocation and write-downs. The JUL and related investments highlighted poor capital allocation decisions. These write-downs weighed heavily on earnings, investor confidence, and management credibility. Regulatory uncertainty misjudged. Altria underestimated the speed and intensity of regulatory actions against vaping products. Changing FDA policies and enforcement created a much tougher environment than initially expected. Slower than expected transformation. While Altria has been working to transition away from combustible cigarettes, the shift toward reduced-risk products has been slower than planned, leaving the company more dependent on declining cigarette volumes. Now let's look at the key opportunities for Altria going forward, especially from a 2026 perspective. Despite declining smoking volumes, Altria continues to demonstrate exceptional pricing power. Regular price increases have historically more than offset volume declines, supporting stable cash flows and high margins. Altria's biggest long-term opportunity lies in transitioning towards smoke-free alternatives. Heated tobacco and next-generation nicotine products remain a strategic priority, and any successful execution could materially improve growth expectations. Oral nicotine pouch brand continues to gain market share in the U.S. This category benefits from fewer regulatory restrictions compared to vaping and offers strong long-term growth potential. Altria remains one of the highest-yielding dividend stocks in the market. For income-focused investors, consistent free cash flow generation supports dividends and share buybacks. If regulatory pressure stabilizes or becomes more predictable, investor sentiment toward tobacco stocks could improve, leading to valuation expansion from currently depressed multiples. Now let's look at Altria's numbers and long-term performance. Over the last 10 years, Altria delivered an annualized return of 7.2%, including dividends and reinvestment. This confirms that Altria has historically been an income-driven compounder, not a growth stock. The P/E ratio of 11.3 shows that the stock trades at a clear discount to the broader market, reflecting regulatory risk and limited growth expectations. With a beta of just 0.5, Altria is a low-volatility stock, meaning it tends to move much less than the overall market. Valuation also looks reasonable, with EV to EBITDA at 9.3 and price to free cash flow at 10.9, supported by strong and predictable cash generation. Leverage remains under control, with net debt to EBITDA at 1.8, giving the company flexibility to support dividends. What truly stands out is profitability. Altria generates an exceptional ROIC of 47.24%, alongside a net income margin of 44% and a gross margin above 52%, numbers that highlight the strength of its pricing power and brand dominance. To wrap it up, let's talk about dividends, which are the core of the Altria story. Altria currently offers a dividend yield of 7.13%, placing it among the highest-yielding blue-chip stocks on the market. The payout ratio of 77.93% is elevated, but still sustainable, thanks to Altria's strong cash flows, high margins, and disciplined capital allocation. This is not a growth stock, it's a cash flow and income machine, designed for investors who prioritize stable, long-term income over capital appreciation. Final take: Altria makes sense as an income anchor in a diversified portfolio, a hedge against market volatility, and a stock for investors comfortable with regulatory and long-term demand risks. Thank you for watching. If you'd like to see more dividend stocks, consumer staples, or valuation breakdowns, let me know in the comments what company or metric you'd like next. Don't forget to like, subscribe, and share, and I'll see you in the next analysis.